Good morning. Very excited to be here. Although I'm only 20 years old, this is the 43rd conference that I've attended here at NYU, so I'm flattered to be here with my esteemed data colleagues. We're going to mix it up a little bit this year and go down the line. Everybody's going to do a 3-minute presentation with 2 slides, and then we're going to have a conversation. So, Amanda, please introduce yourself and take it away.
Thank you. Amanda Hyde, I'm president of STR. I'm not going to say how many conferences I've been to. And the slide is already on the screen. So we have a revised forecast for you for this year and next year. And it's a pretty significant downgrade of RevPAR growth for this year. We expect RevPAR growth to come in at 2%. And that is really driven by the horrible first quarter that we had of demand declines, but demand coming in lower than what we expected. We've also moderated ADR growth just a little, but we will end up with actually negative occupancy growth rate for this year. So our RevPAR gains are going to be entirely driven by that rate growth for this year. So we do expect a little improvement in 25. But we still have occupancy growth under 1% for 25, which means RevPAR growth is again going to be driven by rates. But if we look at the chain scales, this is where you can really get a sense of what's happening out in the industry. So I'll focus on the chain scales where we see the biggest revisions for this year. The luxury segment was actually a pretty significant downward revision. We expect RevPAR to be slightly negative at 0.2% this year for the luxury segment. And that's being driven by 2 things. New supply, like we've had a lot of new supply come into the luxury segment this year, and also rate growth has moderated. And so we've brought the rate growth expectations for the luxury segment down. And that's really driven by the business mix change that we've seen in the luxury segment this year and just the normalization of ADR growth with the post-pandemic surge that we had seen. And then mid-scale and economy, also big revisions of downward pressure on those 2 segments. So we don't expect things to really improve a whole lot this year, negative RevPAR growth, but we do expect the rate of decline to slow. So it will be not as significant declines in demand and occupancy, leading to that negative RevPAR for both of those segments. And things will start to turn, and we expect it to go positive in 25. And then the upper upscale and upscale segments, those are really the stellar superstars continuing. You know, upper upscale really benefiting from the return of group demand. We'll see the strongest performance across the segments in that upper upscale category this year.
Thank you, Amanda.
Thank you.
Thank you very much. So from our side, just focusing more on the profits, and you can see from the first 4 months of this year, it's been quite a tough start, albeit on the back of a pretty strong 2023. The graphic here is showing the margin declines year to date, so around 1.2 percentage points drop in profitability across the board in the US, and it correlates directly with the 1.2% increase in the labor margin. I apologize, I just noticed before I came on stage that the graphic is inverted, but actually just to make it clear, it's 1.2% increase in labor margin. And of course, that speaks quite directly to the challenges that the previous speaker was talking about, and the challenges many of the operators will be aware of, because above and beyond the kind of average, the aggregate across the nation, it's not just by state and by region, but also, of course, the other challenges, the various layers of the labor market, where the section of the labor market that the hotels rely on, the numbers are significantly higher, almost double the wage increases that we've seen year on year. And of course, with challenges around revenue streams, this is certainly hit hotels in the first 4 months of the year. This graphic taking it a bit more global, because of course, on a global level, we are seeing revenues slow almost to a halt, right? So back to very much the kind of pre-pandemic levels of annual growth. This is looking at a 12-month moving average over the past 4 or 5 years. And actually, there's a few things you can take from this. Number one is the fact that in the US and Europe, you can see that the numbers have basically slowed to a halt. Asia Pacific more recently, as there's still quite a bit of jumping around in the Chinese numbers. The Middle East continues to go from strength to strength. And in fact, the other thing you can take from this is if you look at the global share, although the US is by far the leading player from a revenue perspective for hotels, the share has actually decreased over the last 5 years. And in fact, the Middle East as a region has taken over Europe as the kind of second biggest player from a hotel demand and revenue perspective. And of course, hoteliers have done really well. It's not just the labor margin issues, but also across, insurance costs have increased significantly, supply costs have increased significantly over the last few years. And as much as we see revenues slowing almost to a halt, the costs are still, of course, creeping up quite significantly. So hoteliers, I think, have done quite a stellar job over the last 18 months of offsetting this cost creep with revenue growth and adjustments to the operating model. But I personally think the next 12 months are going to be very much around really looking at ways of, whether it's automation or ways of driving operational efficiencies as revenues are slowing, as Amanda's just alluded to there. And you can see from this graphic also.
Thanks. Hello, everybody. Rod Clough, I lead HVS here in the Americas. Have up on the screen the results from our spring broker survey. They are now a couple of months stale, but I think still pretty good. The 6 numbers to remember really, because I know there's a lot up there on that slide, is 7, 8, 9, 10, 11, 12. On a cap rate basis, if you're looking at a property that is relatively stabilized, nothing too funky about it, in the upper upscale world, you're going to be looking at about a 7 on a going-in basis, and then 8 for a full-service hotel that's maybe more along the lines of a mid-rate, not quite an upscale, or a select-serve hotel, and then a 9 for a limited-service hotel, cap rate-wise. So things are slightly different from the broker's opinions. In real world, broker opinions are looking more at a stabilized basis. On a T12 basis, the cap rates are going to be lower because the buyer is going to expect to initiate some cost savings and benefit from that next year of revenue growth. So on a cap rate T12 basis, you'll be closer to 6 to 6.5, 7, 7.5, 8, 8.5 for limited service, depending on your product type. Same thing with discount rate. You'll be at 10, 11, and 12, or just shy of 12. So 10 for your better quality, upper upscale properties, 11 for your select serves, and maybe 11.5, 11 and 3/4 for limited service. You're applying those numbers to your EBITDA after reserves, so you want to just be mindful that those numbers are where they should be, given the forecast that we've heard here today with RevPAR not really making that big of a move up in the near term, which HVS certainly agrees with. The real opportunity comes in driving, what are you doing to drive profitability? Is your full service hotel in the mid 30s at GOP? Is your select serve in the low 40s? Is your limited service in the upper 40s? And maybe you can get above 50 for your extended stay property. If you're not in that ballpark, I guess I should go to the next screen. Target the right EBITDA. If you're not at that place, that's where the opportunity is right now in the cycle, because it's not necessarily going to be on the RevPAR growth side. So really looking at that and looking at your management company. I'm going to borrow a minute from the other two, and really questioning, like, what are you doing to get the right EBITDA and the right profitability, extracting that alpha out of my property? It's key right now. We're seeing it go both ways, where management companies are being properly aggressive, they're doing a good job, they're driving a lot of alpha and profitability out, and then there are other management companies that are just complacent and they're living in this old world that we need to get out of. So there's a lot of opportunity there. It's going to be more on the EBITDA side. The dollar per square foot, maybe something we'll talk about later in today's session. Are you extracting every square foot on your property? Are you extracting the dollars that you could be out of it? Particularly since that bed, maybe you can't do so much anymore in the guest room. So what are you doing outside of the guest room? And managing that PIP cost is key right now, because they're going through the roof. And for some of these limited service hotels in in some of these markets that just cannot command an ADR increase of any substantial amount, does it really make sense to pour that kind of money into these assets? And what can we do to better manage that, I think is a challenge. Okay, now it's your turn. Here you go.
Thank you. Good morning, everybody. I'm Ben Harrell, Managing Director for the US at Booking.com. Going to show a slightly different cut of data than what you've seen here. Going to talk about loyalty. I've heard loyalty is important. We looked at leisure travelers in the US, and you can see we've sort of estimated about 90 million online leisure travel bookers in the US. And we try to understand their preferences, particularly their preferences for OTAs versus booking direct with properties. Maybe you've heard this as an interesting topic. We found something very interesting and not quite what we expected. We found direct exclusive, about 29% of these bookers prefer to book with the brands directly. It's a good percentage. And about 22% prefer to book with OTAs. They have different rationales and reasonings for wanting to book either direct with the property or with OTAs. But people in both groups, very hard to persuade to jump to the other side. It's funny, we hear a lot of people talking about how OTAs and chains compete for loyalty of consumers. And the data we've seen is, it's just not true. Mark Twain famously said after hearing reports that he was dead, the report of my death was an exaggeration. I would paraphrase that and say the report of OTAs competing with chains is an exaggeration. We're just targeting different consumers. You probably noticed that these numbers don't total up to 100%. That math's not too hard. There's also a pretty large group with no set preference. This 46%, sometimes they'll book direct, but they don't always book with the same chain. Sometimes they book with OTAs, but not always with the same OTA. Loyalty is not really what they're after or what they're driving. And then you've got a large, small segment that are still booking with travel agents. It is interesting to think about this. We think about Booking.com has a loyalty program, our Genius program. We like to talk about how simple it is. The reality is Genius as a program doesn't compete with loyalty programs of chains and others, actually works pretty well with them. So wanted to share this data. I think it's interesting to talk through how our programs work together with chains and other direct loyalty programs, really not competing as much as it might seem in a lot of cases. Let me pass the remote back over.
Great, thank you very much. I'm going to take just a couple of minutes to talk about the latest outlook by Ryan Melliker, who's my partner in lodging, analytics, research, and consulting, LARC. LARC does not believe that corporate transient demand will get back to pre-pandemic levels. However, we do see continued growth in that segment because the metrics of the stock market, strong employment, positive employment, investment in business investment and corporate profits are all looking very strong. Group demand is looking strong for the remainder of 24. When you look at the booking pace of the top 30 convention centers in the country, that's good news. The bad news is that the outlook for next year is a bit of a decline, a tad, so that may create some headwinds. A strong US dollar has absolutely made overseas destinations on sale for Americans, and they're taking full advantage of it. International inbound travel in 2023 was down about 16% when you compare it to 2019. That's the bad news. The good news is that this past March, that delta was only negative 4%, so it's getting better as time goes on. And then, of course, we heard from Ellen earlier about the fragility of the U.S. consumer, particularly the middle class and the lower class, and it's starting to appear like there may be cracks in terms of consumer confidence and, candidly, leisure travel. This next slide, U.S. transient lodging demand has clearly declined for 4 straight quarters, rendering Q1 24 RevPAR essentially flat. It's interesting to note that during the past 4 presidential election years and 5 out of the past 6 presidential election years, demand and revenue per available room growth has decelerated compared to the prior year. So that's sort of the expectation for 24. But next year, once there's clarity on who's going to be running this country, it should rebound. So with static occupancy levels and a softening of group demand, ADR is expected to have very limited growth during 25. Outside of a handful of markets, wages seem to have stabilized, and so hotel EBITDA in those markets can definitely continue to grow. From a cap rate perspective, we don't expect cap rates to stabilize below pre-pandemic levels. Again, that's the bad news. The good news is there is so much capital out there, both debt and equity, and increasing cash flows, that we believe that values will increase modestly over the next couple of years. And the last thing I would say is that, obviously everything we're all talking about are sort of national averages, and we all know that the hotel industry is a street corner neighborhood business, and you really need to look at submarkets, right? San Francisco is not the same as New York, as we all know. Okay, great. So now we're going to get into the conversation. And Amanda, why don't we start with you? Your forecast is a bit of a downgrade, and it's actually more of a bit of a downgrade. Give us some insights as to why you're feeling bearish compared to only January this past year, or this year, when you were feeling much more bullish.
Yes. Well, we expected the overall economy to strengthen and we would have GDP growth. And typically we see hotel demand increasing when we have GDP growing. We've only had this happen 4 times in the past, where we see this decoupling of demand growth from the GDP growth. I think what we missed was the higher inflation for longer than expected and the impact that that's had on the middle and lower income classes. And that's where we've really seen the demand weakness. So when you look at the overall industry, we've had this bifurcation of upper tier chain scales and lower tier. I mean, there's a clear delineation between the two. When you look at our upper tier segments, that's upscale through luxury, we actually have demand growing. So demand growth of 2.1% for year to date, for the first 4 months of the year, and we have RevPAR gains of 1.8%. And then you look at the lower tier segments, and we've got demand declining 2.5% for the first 4 months of the year, with a negative 2.4% RevPAR decline. So the rest of the year, we expect to see that same sort of trend. We're going to see growth in the upper tier. We're going to have demand increases in the upper tier this year, but the lower tiers are still going to feel the pressure of that higher than expected for longer inflation. Those consumers have made cuts to their spending, and unfortunately, that's been in travel on the lower tier segment.
Great, thank you. And by the way, anybody feel free to weigh in on any of the questions that I'm going to ask. Michael, U.S. profit margins are clearly under pressure. There's no question about that. What are you seeing in other regions?
So I think different regions have different kind of fundamentals and base points. I think if you look at like the Middle East, for instance, there's been significant, like almost record level rate growth across, certainly in the luxury segments, and there still seems to be more to come. At the same time, during the pandemic, hotels were able to strip out significant amount of costs. So actually we saw revenues up, costs down. So actually the margins have grown between 7% and 8% across the key regions. In Asia Pacific, it's still fairly early to say, but if you look at stabilized performance as it is for the markets that have started to see some kind of flatlining, We've seen a similar thing there. Europe is, of course, in a totally different state because, as you heard earlier on, it's not just the challenges around staffing and the supply cost issues. Energy costs went through the roof also. Some operators were dealing with 300% increase in unit price on energy costs last year. So actually this year, if you look at the year-on-year impact, Europe has actually seen an increase in margins, but it's pretty much all related to this drop in energy costs. So I think that's the difference here is that, European hotels have been forced into really driving their costs down because they had to try and, offset some of this challenge around energy costs over the last 18 months or so. So we're actually probably better set up for the current situation. But I think in the US, we've had such, significant revenue growth over this period of time that hotels are possibly not. I think now is the time to switch into that kind of mindset of really re-looking at the operations in a similar way we had to do over the last few years.
Rod, how important is it to strategize to reach a certain EBITDA percentage as opposed to what we're all typically hyper-focused on, which is top-line metrics?
I think right now it's more important than ever. I'm looking at any 1 week, I might have 3 or 4 hotels that are kind of top of mind that are getting the most attention and on my desk, or if it's not a portfolio. And the difference that I'm seeing in performance for hotels that are very similar type of constraints, labor constraints, they might even be in the same general market, the margins can be quite different. And they really shouldn't be. We just finished some work where we would go to the properties and there wouldn't be a GM on site because the GM had left months earlier, and the GM before that had left had only been there for 8 months, or the GM that's there is an interim GM that doesn't know anything about the market or anything about the property. And for me, just being a lover of this industry and a lover of wanting hotels to have proper value, because that's what, we're here to invest in hotels and have good investments. It's a head scratcher. Why is this happening? Why is this property not being properly managed? Why isn't it singing in the market? Why isn't it doing as well as this other one that might be across the street or down the road that's just hitting it out of the ballpark? So now's the time to really be focused on what is the story at your properties or property, and stop believing this notion that we're going to get back to pre-pandemic and it's just this for this reason or that reason. I wouldn't buy any of those excuses. The market is what it is today, and there's not going to be any monumental shift. Like this is the world we're in. So just love it and get the most out of it. Figure out a way to make it work, because I am seeing properties that are operating with occupancies in the low 60s and a decent ADR, and their their GOP is in the high 40s. Like they're making it happen somehow. The GM is extraordinary. The people love working there. The guests are happy. Everything is good. So it can happen.
Thank you. And let's not forget, too, that we are in a very unique period of time. I cannot remember when hotels were perceived as a darling asset class compared to other commercial real estate like office buildings.
Yeah.
So we're living the dream right now. Ben, what are some of the trends that you're seeing with travel in U.S. markets?
It's interesting. We talked to lots of different people, and one of the things I've heard a lot from hoteliers is that they see the advanced purchase window or the book window getting longer. Interestingly enough, when we talk to people that manage short-term rentals, they talk about the book window getting shorter. And I think as we've started to look at the data, one of the things we've realized is that you have historical short-term rental bookers that are used to booking very far in advance are now open to booking hotels. That's an opportunity if you're running a hotel. But they are booking farther in advance. We also see historical hotel bookers that are open to short-term rentals, and they're booking more last minute. And so what happens is as these new types of bookers are interested in the properties that you are running, the properties you're investing in, it's playing funny games with the book windows, with the advanced purchase windows. And so we see some changes there, and everyone's looking at part of the picture, but really what you have is not, well, I'll call this opinion here, hard to get totally definitive data, but I don't think you have people that are booking so much farther in advance or so much more last minute, but different sets of people are shifting to being open to different types of properties and different types of bookings. And that makes, when you're running a property, that makes what you see coming in be different. It's interesting, right? At Booking, we offer both alongside each other. And so we do see those preferences changing and people being more open. And so I think you have an opportunity that you haven't had in the past to persuade new types of customers to come and book your property, which is it's pretty exciting, but it does move the numbers around.
Great. Amanda, coming back to your forecast. You see the next 8 months being better than the first 4 months. Tell us some of the reasons why.
Yeah. Well, the number one, GDP growth for 24 is going to be as strong as it was for 23, which was not our expectation. We had expected by the end of 23, we were going to see GDP growth really slowing down. And as we've seen, the economy's been stronger. I mean, that's good for our industry. I know I just said that hotel demand growth has decoupled from GDP growth right now, but it's very good, solid fundamentals that, and then you look at, employment, it's still very robust and strong. You've got, while average hourly earnings have come down a little, earnings are still above the rate of inflation. So people are still making money. We know that travel will continue to be prioritized. When you look at the May performance, our prelim numbers for May was really strong month. Like Memorial Day was a great holiday for us. So we know we're confident in that, and with GDP growth continuing to increase, that will be positive. When you think about, we've spent a lot of time talking about the economy segment, mid-scale. When does that turn? Is there anything to be positive about there? Why do we think it's going to, the declines will get less? There's a lot of investment in infrastructure spending that has to happen. That's been approved. Money has been allocated, it has to get spent, and that's going to be a really good lift, we think, of investment that what causes people to go stay in the mid-scale economy hotels when that infrastructure bill spending starts happening. I think that's a really positive piece of news to help us feel better about things easing for the rest of the year in those segments.
Thank you.
It's nice, sorry, I'll just chime in here. It's nice to be optimistic and see things going forward. We heard pretty optimistic commentary in the first session this morning. Anytime you hear economists saying positive things, that's good. I studied economics, so I can say that, I think, without being offensive. There's always opportunities. There's always challenges and difficulties as well. But I think it's on all of us to try to seize the opportunities that come up as market dynamics shift and adjust. They'll never stop changing. They'll never stop evolving, but there's always opportunity. I think there's a lot of opportunity looking forward.
Yeah.
Agreed. Michael, with revenue per available room slowing, what are you seeing for other revenue sources like F&B, wellness, and the like?
So again, I think when we see less guests staying in hotels, obviously one of the ways to really try to prop up the profitability of the hotels is to find revenues from elsewhere across the building. And of course, food and beverage trends generally globally have shrunk. So it's been well at the rate of growth that we've seen in ADR and in other areas of the business. Food and beverage has lagged quite far behind now. In fact, in Europe, margins have declined in food and beverage by kind of 8 percentage points on average, and that has mostly been driven by the fact that hotels are maybe less attractive from a food and beverage outlook point of view. There's many more options outside of hotels. But I think the big chunk of it was the conference and events, the conventions. It's great to hear the convention spaces are doing well, but actually hotels have lost quite a lot of demand for conferencing to those convention spaces, right? There's been, I think that's been a shift that we've seen since the pandemic. So conferencing, recovery is still very much in motion. In fact, I think we're stabilizing quite far behind 2019 levels from a conferencing point of view. Food and beverage spend per occupied room for the US is down by about 0.5 percentage point year on year. And again, as costs are increasing, that becomes more and more of a challenge. The upside really has been in the wellness space, where continual growth across the regions. And again, there's global patterns you can see here in the numbers, where guests are willing to spend more and more in not just in the spa and leisure facilities on property, but in the type of hotels that offer those services. So beach resorts have seen the biggest growth globally from an asset class point of view. Again, we track spa and wellness resorts, golf resorts. Those areas have done significantly better than the other asset classes over the last few years. So there are the positives. There's definitely seems to be a change in guest habits, and food and beverage is certainly the one area that's even more of a challenge than room demand as things currently stand. And I think that's another area where we need to get a bit more creative how we serve that.
Thank you.
I'll just piggyback off of that and say with wellness and with how I'm still seeing some of these prototypes come out from the brands here, which many of you represent. It's one thing for a resort, I get it, but for like the regular everyday hotel, why they are still coming out with swimming pools is beyond me. Like, we cannot afford to build those anymore at these RevPAR levels that aren't moving. And how many times have I or you gone to work out and there's 2 treadmills, they're both full, and the weights go up to 40 pounds, and there's one little bench there, and nobody's in the pool. And the workout room is tiny. That's a problem. Like, and you all can fix it. Please, stop building pools. And build a bigger workout room. Like, I love, there was a Courtyard, and thank you, Marriott, for allowing this. A Courtyard took their pool and turned it into golf bays that you get to pay to use a virtual golf bay, and then you get food and beverage brought to the golf bay. So they turned the pool into a revenue generating space. Now, I don't know the ROI on that. I don't know how much it costs. But, or I've heard, I think of another Courtyard that turned their pool into the gym and then turned their gym into a meeting room, which is fantastic, like just fantastic. If any of you have been to the Fontainebleau in Vegas and been to their gym, that is why I shouldn't plug, I don't know if it's the right thing to plug Fontainebleau like that, but going back to Vegas now, I am staying there because of the gym. And people will do that now going forward. They will book hotels based on the wellness facility that exists in that hotel. Does it sing to what the market is looking for? And so many of our hotels aren't doing that right now. And you could build hotels more cheaply and serve the wellness needs of your guests better. So I really encourage you all to be rethinking that and doing that. And then the last thing I'll say on the whole renovating bit, particularly for the upper mid-scale and the mid-scale segment, is that brands, please create cheaper ways to renovate. The amount of money that's going into the facade redos is insane. And it just is not feasible for these little Fairfields that have 60 rooms to all of a sudden put up, and it's not just Fairfields, I don't mean to put down Marriott. Like, it's the whole industry. Like, do we really need that? Isn't it better just to have a better bathroom and a better bed? I don't need a new facade.
Rod?
So
I like to go swimming every morning.
Yeah, me too. I was going to say that.
wait.
Please don't discourage
Let me just say on the pool thing, I have kids now that are 18 and 22, but back in the day, we liked to go swimming too. But do you know where we went? I know this is going to maybe sound odd to some of you, but these towns have the most amazing rec centers with slides and things like that. So there will always be a pool there will always be a pool for you, Dan.
Ben, what do you see in terms of generative AI and how's that impacting the industry?
Yeah, Gen AI is going to change a lot. I don't want to say it's going to change everything, because it won't. Hospitality is hospitality. I'll tell you what it's not. On Saturday, I was grocery shopping, and my grocery store has a robot that autonomously goes around looking for spills, and when it finds a spill, a little light goes on. It doesn't do anything. It just sneaks up behind you and has a weird smile. It's not that. That's weird. But we've launched, about a year ago, Booking launched an AI trip planner, and you can go on. This is also not the future of Gen AI, but it's a great place for us to learn and grow and understand preferences. I think the future of Gen AI and the future of AI in general is about helping people get specifically what they want. If someone says, I want a hotel with a large gym and without a pool because I hate them, there's not a good way to find that today. You can find a hotel with a gym. You can find a hotel without a pool, but actually the combination, you're okay with the pool as long as they have a good gym, right?
Yes.
Yeah, okay, got it. So finding exactly what you need, right? Not just a gym, but a large gym. This is really hard for us to do today. Gen AI can help quite a bit.
Yeah.
Being able to get people exactly what they're looking for, helping people narrow down to exactly what's perfect for them is really going to be something that Gen AI will help us tackle. And it's going to continue to change and evolve over years. We've been working with AI tools for over a decade at this point, but has made a lot of progress over the last year plus with some of these tools being a lot more available in public. It's going to be a hot space to watch and pretty exciting.
Great. Thank you. Michael, budget season's coming up very soon here. How do you see the next 18 months playing out from a margin perspective?
The great thing about this, I can say whatever I want. I'm going to be wrong anyway, right? So,
Yes.
I think obviously there's so many fundamentals behind the numbers that we're talking about today, right? There's some assumptions we need to make on what's going to happen over the next 18 months with regards to inflation. If we see revenue growth at this trajectory for the next kind of, into the end of this year and into next year, it's clearly not going to offset the cost creep, right? Because even if wage rates get down to that kind of, 4 or 5% mark, and inflation is down to, 3, even 2.5%, whatever it ends up at, it's still going to be higher than the projections that we have. So it's quite easy for me to say across, on an average, we'll see margin declines. That said, there are a lot of opportunities. I think Gen AI is a great example of one of the opportunities that we have to relook at our operating models. And during the pandemic, a lot of the operators we were working with were, again, remodeling, looking at, for instance, across the various brands or the various asset classes that they operate, and starting to rethink about, if we did these things, if we relooked and centralized these costs. I think the relationship with the owners has changed. Generally through the pandemic, because hotels were forced into trying to get to a break even, trying to get to cut down costs as much as possible. So there is much more ability for us and much more technology available to at least strip out those back of house costs, those the areas that I think for many of the regions we saw quite a big change during the pandemic. We haven't really seen the same here in the US because we've seen such quick revenue recovery. So I think that's clearly an area of opportunity. For offsetting some of those challenges we're going to see in margins over the next 18 months.
Yeah, I'd just add, what makes me nervous for us is that the pressure on margins, and all of our RevPAR gains are relying on rate growth, and our rate growth is not keeping up with inflation anymore. So inflation has been running ahead of rate growth. So it's going to be, while there's a lot of good demand growth in upper tier hotels, it's concentrated in some top 25 markets. Everywhere else, it's a challenging, we know it's a challenging year, and there's going to be a lot of pressure on margins.
We should also say European hotels have seen around 3 percentage points drop in margin since 2019, and the US is sat at around like 0.5%. I think it's like 0.7% versus 2019. So, we haven't really seen that, hemorrhaging of the margin that we've seen in Europe, but we haven't seen the uplift we've seen in the rest of the world. So there is still quite a lot of unknowns, but, if costs are continuing to rise in the way they are, it's really going to be around how we can find new revenue streams and optimize those, and of course, really look at the operating models.
Unfortunately, we are out of time. We could continue this conversation for much longer. I would just like to take a minute to congratulate my friend Dorothy Jennings. and Alexi for taking over this conference. Thank you, panelists.
Thank you.
Thank you.